All right, what's up, guys? Jeff Kamke here with Wealth Energetics. I'm here with my good friend Matt Toyshel from Millennial Wealth Creator. We're going to talk about some good stuff today. I appreciate you guys tuning into the channel. And one thing I was looking at the other day, I was watching a Chris Kirkpatrick and Caleb video, and it got me thinking about, I've been in the industry now for I think 6 or 7 years. I forget exactly. I think it was 2018, somewhere in there when I started coming into the industry as a customer first around whole life insurance because it fit a very particular need that I had in my family. And I've got the story in that and other videos on my channel, so I'm not going to go into that here. But the product of whole life insurance, cash value whole life insurance, was a big part of my personal journey and my personal story. And I didn't become an agent first. I was a customer first because it fit a solution to a problem that I had in my life to where I didn't have enough money to go around. I didn't feel like, and I needed money to be doing multiple things for me. I needed more efficiency out of the money that I already had moving through my hands. And I need to protect me and my young family. And whole life insurance fit that very perfectly. And once I realized what that was and the power of it, I wanted to become an agent as well. And so that's something that my wife and I did. And, along our journey, when I was watching Chris and Caleb's video the other night, it kind of gave me this perspective, kind of snapped me out of like where I'm at. Like, wow, I've been in this for a while and my understandings have evolved. My education has deepened and what I view the tool of whole life insurance has definitely evolved over time. And so in this video, I want to go into a little bit of that, of my journey, and Matt's going to share some of his journey as well, of what we've learned over the years and how we were taught about what we call infinite banking. It was dubbed private banking concepts for the way I learned it, but same basic concept where you're using a cash value whole life insurance policy and you're using it in a way where it's allowing your money to do multiple things at the same time. So whether that's giving you a death benefit, it's growing cash for you. It's giving you some asset protections, doing a lot of different things that can help your money go further. And, when you're doing those things, and you're taught a certain way, you see things from a particular perspective and you don't necessarily know what you don't know, right? Until you are around other mentors and you're around other training. And it's something that I think both of us do, Matt, where we intentionally go outside of our boundaries, outside of our belief systems. We go across the aisle. We go to the other side of the world of finance, and we listen to people that are all about IUL, and we want to understand buy term and invest the difference. And we understand different points of view, and what helps make us better at what we do, because we're not all a one size fits all, where whole life is everything and everybody fits into whole life. And that's part of my journey. And I'll get into some specifics here of just how my understanding has changed over the last several years. And, where it started was really around what you see a lot of the flashy TikTok videos around infinite banking, where, it's you can go buy a car and you make money buying a car because you have this cash value in your whole life policy. You borrow against that, go buy a car. And instead of paying the bank interest, you're paying yourself back the payment plus interest to restore the cash value in your policy loan. And while you're doing that, your cash value inside of your policy is growing and you're putting extra, interest that would normally go to a bank back inside your policy. That's the way I was taught. That was like the foundational functionality of a cash value whole life insurance. And, since that I've understood that's maybe not the best way to go about it. Now, can it work? Yes, but that's not really the way you want to lead with that tool. It's more about how can this tool solve problems that you might have in your life. And usually the problem isn't, buying cars and all that. It's usually access to capital is something that a lot of business owners find that I don't want to have to go to a bank. I don't want to have to succumb to what I've heard many joke about is the proctological exam of getting an
Hmm.
application or a loan approved, right?
It's
It's
always fun
sometimes
stuff.
it's, like the blood draw, the DNA sample, do you
Hmm.
qualify and all these different things? And it can be a little crazy. And I've been through that numerous times over the years and it's not fun. And if you have a system that allows you to access capital without that, that can be very attractive for a lot of business owners.
Hmm.
And we're big advocates now of having, following some of Dave Ramsey's steps of having savings and having a portion of your savings inside of cash value life insurance. And those are some of the evolutions in my thought process. Is it's not just about going on vacation and taking a policy loan from your whole life insurance policy to go on vacation and repaying that back and then doing it again next year and thinking that's going to get you to, the super rich, wealthy lifestyle by doing that. Now, you can look at some math and you can see that, yeah, okay, there can be situations where that might work. But if that's the angle you're going at it from, it's really not the point. You're missing the point. The point is having much more control and efficiency over all the different buckets that we have money in, and where can that money help us do more things, do it more efficiently, let those dollars go further. So things like, having it serves a lot of functions all through your life, I'll add. So it could be things for like college. There's a lot of benefits to using cash value in a whole life insurance policy. If you're wanting to put money away for your kids, it can be in addition to, or in a totally replace a 529, depending on your philosophy on that, depending on who's guiding you in that. There's things with that. It can be working capital in your business, like I've already mentioned. It can serve as a lot of things towards retirement that are there. And those are some of those early on understandings that I didn't have. I thought it was just you're making money because you're buying the car and paying yourself back, going on vacation, paying yourself back. And that's where the true power was. And I didn't learn until later, until I, kind of grew out of my mentors that I had and started seeking other opinions and the people that criticized infinite banking and listening to what they had to say and saying, okay, is there merit to what they have to say? They rip on the philosophy and that the math doesn't work and it's a scam. Well, is there any truth to that? I wasn't going to be a blinded insurance agent saying, no, they're wrong. Like, let's actually take a look at it. Let's see if what they're saying has any merit. Maybe they are right. Maybe I'm wrong. Maybe, I'll totally be teachable in that moment to say, maybe I don't know it all. I'm young in the industry. I'm not some, $1 million round table earner that I think I know everything in the business. Let's take a look. And so as I did those things, my opinions have changed. And I see the bigger picture now of where whole life can be used as a lifelong instrument to solve a lot of problems and help your money go further, help you have more certainty around the money that's flowing through your hands. And so I think that was one of my big cognitions that I had, and just seeing that difference between the infinite banking concept and seeing that this is a much more expansive tool that can be used in so many more ways. And I'll go into other ways, but I want to open it up to Matt and invite him into the conversation. And anything I've been talking about so far, I know, you might have some thoughts on that, but then if you have any, parts of your journey that you've evolved in this understanding, I'd love to hear some of those, Matt.
Yeah, man, that was all really good stuff. And it got me thinking about specific parts of my journey when I got started with this as well. And I got started same way that you did, as a customer, right? My primary business is my online marketing agency. And I was starting to make some money. I had a pile of money. I wanted to start putting it to work. And so I started going down the rabbit hole of like, where are the best places to put my money? And I'm pretty risk averse. I'm not really a stock market guy, and like the tax qualified plans, it just doesn't fit for me. I'm not saying they're bad, but it's just not my thing. And it really opened me up to this world of just really pushing back against mainstream financial media, where you alluded to this earlier, where they try to, it's like a one size fits all solution for everybody. They try to fit everybody into this one solution, or this one philosophy or ideology, whatever you want to call it. And one of the things that, one of like the pivotal things for me, or benchmark things for me, I guess, was just how important it is to do our own research and to take control of our personal finances versus just taking at face value what mainstream media tells us to do, or financial professionals, just because they have this fancy degree, they've been doing it for 20 years, whatever. Again, not saying they're bad, they don't know what they're talking about, but just starting to question things. That was the big thing for me is, okay, maybe this infinite banking thing is a scam. I don't know. But I'm not just going to take that at face value. I'm going to do my own research. And Jeff, when I started to run the numbers for myself, that's when the light bulb moments really started to happen for me. I was like, oh my gosh, you got to be kidding. For example, if I were to say that I'm going to borrow against my policy at 8%, but my policy is only going to earn 4%, on the surface, that sounds really bad, right? That sounds like a stupid thing to do. But when you actually run the numbers, you learn the difference between compound interest and simple interest. That was a huge moment for me. Also, the difference between average rate of return and actual rate of return, right? Just massive difference in the numbers when you actually run them for yourself. And so that was a big part of my journey, man. It was just questioning things, running the numbers for myself, doing my own research. And when I started to do that, that's when these types of things just became a complete no-brainer to me. Infinite banking, dividend-paying whole life insurance. I wanted nothing to do with IUL because, again, I did my own research as opposed to listening to financial gurus and stuff like that, whatever, and then just taking what they say at face value. So I think it's one of the biggest lessons I got was just how important it is to do your own research. Because how do you know something like dividend paying whole life insurance isn't really good for you if you haven't researched it? If the only thing that you've ever learned is buy term and invest the difference, you have no point of comparison here. Now, after you do your research, you might find that buy term and invest the difference does make sense for you. Totally great. That's fine. But not knowing what your other options are and how those other options actually work, well, that can create some pretty severe financial consequences long term that you might not even realize. Like another one for me was the idea of eliminating lost opportunity cost, with these policies. When you use them right, oh my gosh, man. Like when I used my policy to purchase my vehicle, I ran the numbers on how much wealth I put back into my life over the next 40 to 50 years. It's hundreds of thousands of dollars that I get to keep and earn in my lifetime by simply changing one thing in my life. And that's where I put the money first. That was it. Right. And one other thing that you mentioned that was a big part of my journey as well was, like this infinite banking thing where, you're going to get rich by buying cars and going on vacations and stuff like that. And what that says to me is, like, for me, that's mainstream financial media philosophy entering into the infinite banking space and whole life insurance, where we're putting so much faith in the financial product itself to solve all of our problems. So when I hear somebody saying, hey, you're going to get rich by going on vacation just because you set up this policy, you're just, now all you're doing is you're hoping that this financial product is going to solve your problems and make you rich. It's probably not going to do that. Right now, with whole life, you design them right. They get a safe internal rate of return, 3 to 5%, whatever. It's nothing sexy. Can that turn into a decent amount of money over a long period of time? Sure, that's how compound interest works. But you have to, one of the big things, light bulb moments again for me in my journey, kind of a benchmark moment, is that we are our greatest asset, not the whole life insurance, not the 401k, not the IUL, whatever it is that you're using. It's us. We're the ones that make the income in order to put money and deploy capital into these various different products, take advantage of them and all their benefits. We're the ones that do the research and increase our financial education. Like, we are the greatest asset that builds true wealth in our life. Do financial products have a place? Sure. But if you're just going to put all your faith in the concept of achieving your financial goals in one specific financial product, and then I'm just going to use that to go on vacations and buy a bunch of depreciating assets and I'm going to get rich, man, that's one of the things that I just tend to push back on a little bit and try to get people to realize that we are the greatest asset. It's not this financial vehicle. This financial vehicle empowers us to be even greater in our lives. And I'm a personal testament to that when it comes to dividend paying whole life insurance, because it's been an absolute game changer in my life, implementing things like infinite banking. And I just think to myself, had I not started questioning things, right? Had I not started running numbers for myself, had I not started to ask myself, okay, is there a better way to do this than what I'm being told by traditional financial media? Okay, well, that set me down a whole new path where I found all these different tools and strategies and different mindsets as well, different ways of, like, it completely changed the way I think about money. And it's been an incredible journey. It's been super powerful. And that's why I got into the business, because I wanted to share how amazing this stuff can be for the right people. It's not for everybody. And then also to expose some of the stuff that is a little misleading out there. It's just people are misrepresenting a lot of different things, not providing accurate information. Therefore, we can't make informed decisions. And I have a real problem with that. So it's really just about, for me, exposing or just showing that, hey, there's other ways to do this game called personal finance. Here are some different options. Do your own research, then make a decision, right? That's it. So those are some of the big pivotal moments for me. The shifts in mindset were some of the biggest ones. And like running the numbers myself, man, like you start doing that and you start to realize that this stuff can be really, really powerful.
Yeah, totally. I love a couple things you talked about in there. It made me think back to, my early days where it was all about the rate of return on the policy, and that it was almost like this idea that you could like get rid of all other financial instruments, all other financial tools, and just devote everything into whole life. And it's like,
Right.
no, 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 no. Like
Nope.
this is a part of your portfolio that serves a very specific function. It's a very efficient tool that can serve a lot of functions.
Hmm.
And it's not replacement for 401k. If I see stuff on Facebook ads all the time, and it's utilizing the index universal life insurance policy, which they a lot of times will kind of compare to a whole life insurance policy, and saying get rid of your 401k and put it all into an IUL, right? And
Right.
it's I kind of came from that camp of that was even the case with whole life of like you can just basically take all of your retirement, get rid of the stupid stock market, get rid of all the volatility. You don't want any of that in your life, and you want to put it all into whole life because it's the best product in the world and you need to buy it. And
Yeah.
it's like, no, there's a balance here. You still
Right.
have a portfolio. You still need to have a growth element to your overall portfolio. Now, does it have to be stocks and bonds? I think this is where you and I
Yeah.
definitely have created content around before of thinking differently about that. Of there's multiple ways to grow money other than just handing it over to the stock market or a mutual fund or your
Wall
advisor.
Street.
Yeah, exactly. And letting that be, the hands off. Oh, I'm going to wash my hands of it. I have no responsibility to this. And I
Right.
hope that it gets me where I want to get to when I need it. And there's a lot of ways to do that. You've got great content on your channel about your personal journey of
Hmm.
what you're doing in the real estate world around that and doing some hard money
Yep.
lending. And there's other ways you've done some equipment flipping, right, Matt? So,
Yep.
there's other ways to go about it. You can have a business and invest in your business. If you
Hmm.
invest in your business, you can have a big return on money. Obviously, there's no guarantees there, but there's no guarantees in the stock market. And this is
Sure.
something that one of our mentors, Garrett Gunderson, talks heavily about is identifying what he calls your investor DNA,
Hmm.
figuring out what ways are going to align with you to grow your money. And then in the part that's not to be emphasized on growth, what do you have that's safe and secure, dependable growth? That's where whole life
Right.
insurance can fit in that part. And,
Yep.
in Tony Robbins' book, Money Master the Game, he talks about, and as he interviewed, like a dozen or more financial gurus, Ray Dalio and some of these really big name guys that created companies like Vanguard and all these huge, Charles Schwab and all these big, big companies, they all pretty much concluded that you want to have the 40-60 portfolio, 40% in bonds and 60% in the market. That's like the ideal scenario. And so in that split, okay, well, the 60%, let's have that be in a way that aligns with you and is growing your money that you feel good about, you feel safe about, it aligns with what you're wanting. And then the other 40%, not that all 40% has to be in whole life insurance, but there's some advocates for that. David McKnight, he's an advocate for that. Tom Hegna, he's an advocate for that. You replace the bond portion of your portfolio with cash value life insurance
Right.
because the life insurance company is better at investing in bonds than your broker, better than your
Right.
advisor. They've been doing it, at least the companies that we use, they've been doing it for over 140 years or 120 years, like maybe from the lower end. So they know how to make money predictably through the recessions, through the Great
Yep.
Depression, through world wars. They know how to be consistent and stable. Whereas your advisor, he's maybe been in the game max 40 years if he's been around for a while and he's an old guy and, he's got a lot of experience, but not as much as the life insurance company. So if
Sure.
I'm looking for a place to put the safe portion of my portfolio, I want that in the life insurance company because they know
Right.
what to do. And I have that part of my portfolio that needs the certainty, that needs the confidence that this money is going to be there no matter what. And the
Hmm.
growth is going to be there no matter what. It's guaranteed. It's a contractual obligation that they have to me as a
Yep.
policy holder that I know my account value is going to go up every year. And even if the stock market goes down 30%, I can wake up in the morning going, hey, I know this portion of my portfolio is going to continue to grow today because the people managing that part of it, they know what they're doing and I don't have to worry about that. So I think that was a
Right.
big shift for me in understanding, zooming out, I am a financial strategist. That's one of the things that we do is understanding, the bird's eye view of our finances because we get so zeroed in, so siloed into here's our savings and here's our retirement fund and here's our college fund. And they're all diversified out almost to their own detriment to where you don't have enough money working together. It's not a
Right.
synergistic system of finance. It's all segregated to where you can only put so much money in any one individual account, and you're hoping that rate of return is going to solve your problems for you in a lot of these accounts, whether it's your retirement accounts, your investment accounts, your 529s for your kids. You're hoping that the rate of return gets you across the finish line. And that's not always going to do that for you because,
Right.
it's about timing, it's about risk. So having the other part of your portfolio with whole life can balance that out because we want to have risk and we want to have dependability. And for everybody, there's got to be a ratio for that. But I know in my time in the industry, most advisors tend to weight clients more heavily on the market. I was working with a client a couple weeks ago that they're over 70% allocated in the market and they're already in retirement, which is like, no, no, no. And this is a very, very,
Mhm.
very conservative person that's done very well by the book, doing it as the way you're taught. You scrimp and save and sacrifice and delay. And she's done that very, very well. And she's done very well for herself. But now the balance isn't congruent with who she is. And she has an internal struggle now because her advisor has put her in this, category of I got to have all this money at risk because I got to keep growing my money. It's like, no, now we need to shift our thought process to
Mhm.
income. Now you need to dial in income because in a few years, you're going to have RMDs, required minimum distributions. You're going to have a plan for that. And we don't need to keep growing money. We need to shift and start planning for income. And that's where one of the things with whole life can come in is it can be a buffer during your retirement years. So in the
Yep.
years that you have your portfolio that's invested in the market. And I'm just going to speak to that because that's what most people have. Guys like you and I might have it in a business. We might have it wrapped up in real estate or equipment financing or all kinds of cool stuff that, we think outside the box. But most people, are going to be doing it the old fashioned way, the traditional way. And when the market goes down and you don't want to have to take money out of your portfolio for your income in retirement the same year that the market also went down and your portfolio balance dropped. That's a double dip against you. That can really
Right.
hurt you. It can really put your account value at risk to be able to be with you for the long or the duration of your retirement. And that's something called longevity risk. If you outlive your money, you have to become a greeter at Walmart again. And that's where people don't want to be in that situation, but their portfolio doesn't have enough balance on the safe side
Right.
to weather the storm. And there's not a strategy. This goes back to financial strategy. A strategy for, okay, when the market goes down and I'm needing income in retirement, oh, and guess what? There's inflation, so I need more money in my income for retirement. But the
Yep.
market also went down. What am I going to do here to balance that out? Oh, I've got a whole life insurance policy with cash value that I could borrow against that. There's no tax implications until you reach basis, which is the amount you put in. If you've pulled out all the way up to that, anything above that would be taxable. Anything below that is not taxable. You could do that and you could weather the storm a year or two in the down market, let that balance come back on its own without selling shares for your own income, let that come back. And then you can put the whole life kind of back on the back burner again, knowing I have that if I need it, but let's go back off my investments. And that is something that I didn't understand early on in my career in life insurance is that there's that power in whole life insurance that it's what we call a volatility buffer in the industry.
Yep.
It allows you to weather the storm financially. And when you talk to the average person, they've never even heard of a concept like that. They've never
Right.
had an advisor sit down with them and fill that gap. And there's a lot of other gaps that come in a financial plan that I'll get into, but I'll turn it back over to Matt. If you have any other thoughts on that, I'm sure you do.
Oh yeah. Yeah, we could talk for hours on just that segment right there, but just a couple of things really quick. Jeff, I think this is why increasing financial education is so important and taking responsibility for our personal finances again versus just handing it over to the financial professional or Wall Street or your 401k and then crossing your fingers hoping everything's going to be fine. But we don't even consider the distribution phase of that strategy, right? Which is totally different. It's like a complete 180 than a difference than the accumulation phase of building wealth. Like, do you have a plan? Well, like when I hear that somebody is in retirement, still has 70% of their portfolio in high risk assets, what the heck are you doing? So it's just about rate of return. It's just about growth. And is this even the best vehicle to create income? Because there's a very big difference between growth and income. And oftentimes, the vehicles that provide the most growth are not very good at providing income, and vice versa. The vehicles that are good at providing income aren't very great for growth. But that doesn't mean that one is better than the other. They work together. Okay. And that's like, as you start to go down this rabbit hole, learning about how cash value whole life insurance works, then you start to realize that, holy smokes, this actually adds fuel to the fire in a good way for my retirement because it serves as that safe asset during retirement that I could tap into as a volatility buffer if I want. It allows me to more freely spend my assets. Maybe because I have a whole life policy in my portfolio now, I don't have to stick to the 4% rule. Maybe I could do 5 or 6% conservatively because now I have this policy over here that's going to be passed on to my spouse, my kids, whatever, as a legacy play. I don't have to worry about outspending or spending all of my assets so I have nothing to pass on to my wife, kids, etc. Right? So like when you start to think about it that way, it's like, holy smokes, this thing actually can make things even better. Right. Not to mention, so I actually did a video on this earlier today, or I mentioned it in a video that I did, Jeff, talking about it was a video about determining whether determining if dividend paying whole life insurance would be a good fit for you or not. And one of the things that I brought up was if you get excited about high yield savings accounts because interest rates have been pretty high, or like high yield treasury bills or high yield bonds, like things like that, you're probably a good fit for whole life. Not everybody, but pretty close because whole life is a very good bond alternative, alternative savings account, if you will, where, because we have the guarantees and the dividends, which are not guaranteed, but these companies have always paid them. They typically net 3 to 5% tax-free compound growth for the life of the policy. Like you're getting a much better bond. And what's really bizarre to me, when I get comments from people or people say they hate whole life, yet they have a 60-40 portfolio, 40% bonds. Well, if you like bonds, why don't you like whole life insurance? I'm confused here because this will, the internal rate of return of these policies, when you design them correctly, they'll get similar to what your bond portfolio does without the risk. And plus you get so many other benefits as well. Now, are there pros and cons? Of course, you're buying life insurance, so you're going to take that little bit of a hit in the first couple of years before you get back to break even. It is what it is, right? It's give and take, okay? But, that's why the financial education part and doing your own research is so important. Weigh the pros and cons of these different things and then make a decision. But if you don't even know that whole life can do this for your portfolio, how are you supposed to make that decision? What if one simple change in your portfolio, like adding a whole life policy, meant the difference between outliving your money and not? Or how about this? How about whether or not your retirement is extremely stressful financially because you're constantly worried about what the stock market's doing versus I sleep pretty good at night because I have a well-balanced portfolio here. I've got my safe money over here. My legacy play is taken care of. Market goes down. I could tap into that if I need to. I'm good, right? Like, how about the peace of mind aspect of this as well, right? So those are a couple things on that. And then one other thing I wanted to touch on, you mentioned the investor DNA. That was a huge benchmark for me, Jeff, as I was going down this rabbit hole, because I got to the point where, okay, infinite banking makes sense. Dividend paying whole life insurance, absolutely love it. I've done my research. I've weighed the pros and cons. This is a complete no-brainer to me. Okay. So I set up the policies. I have 2 policies right now. The next phase of that is how do I deploy this capital? How do I use it? Right? How do I use these policies to accelerate the wealth building process in my life? Because I don't want the money to just sit there, right? The policies are going to grow. That's fine. But are we going to get rich on 4% compound growth? It helps. Okay. But that's not why we set up the policies. I want to now utilize these policies to actually build wealth, not buy groceries, not go on vacation, not buy a ton of depreciating assets. I did use my policy to purchase the car because of the lost opportunity cost that it saves. Mm-hmm. But I also funded and capitalized my policy in a way that I could do that and I could still build wealth, which is the next phase for me, going down the journey of discovering, like, what is my investor DNA? Like what resonates with me? And it was private money lending. Right now, that's where I'm at. That's my favorite way to build wealth right now because it's very passive. It's much safer than people think it is when you do it right, when you actually do your research, when you commit to educating yourself about it. It's actually far less risky, in my opinion, than the stock market, and you get really good returns. I lent my money out at 12% plus points. Why on earth would I ever mess with the stock market? Now, again, nothing wrong with the stock market. If your investor DNA says, yes, I want to be involved in the market, that's where I'm going to get the most growth, do it. I don't care. But Jeff, you said it perfect, is discovering what your own investor DNA is having this whole life policy, custom designed, set up properly, is now going to be an incredibly powerful, strong financial foundation that's going to empower you to build wealth via your own investor DNA so much better, in my opinion and in my experience. All right. I'm not just, that's not just an opinion. I'm speaking from personal experience, setting up policies, using them to build wealth. It's absolutely phenomenal. Right, but you got to commit to going down that journey. So yeah, just a couple things on that. Like I said, I'll throw it back to you because we could talk about that stuff for hours. But yeah, it's good stuff.
Yeah, all great points, man. One of the things you spoke of early on there was talking about, the death benefit, and reminded me of what Tom Wall says, and I think the name of his book, Permission to Spend, and that when you have whole life in your portfolio, and I've been seeing this with the one particular client I was referencing earlier that had 70%, still in the market. One of the things that we've been encouraging her to do is spend her money. She's worked extremely hard, sacrificed her entire working career. Now it's time to enjoy, the fruits of your
Sure.
labor,
Otherwise, what did you make it all for?
Exactly,
Time to
exactly.
enjoy it.
And you've got, she's got this security in a way that, I've got this nice portfolio, but beyond that, she's still living a, kind of scrimped lifestyle. She's holding on to her money. She doesn't want to let it
Sure.
go. And one of the things that Tom Wall talks about, he's got a PhD in retirement planning and life insurance, retirement planning. He talks about the idea of whole life insurance in part of your portfolio is having the death benefit there so that you can spend what you've worked for.
Yep.
When you pass, the death benefit comes in to replenish.
Yes.
So you've worked your whole life. You've built up a nice nest egg. You've gotten good growth in your portfolio, however that looks to you, in whatever ways you chose. And then you've gotten to enjoy that. You've gotten to travel. You've gotten to add on to the house or, buy that Mustang. I mean, I was behind somebody not too long ago, it was an older guy. I can't remember, it was like a Camaro or, a Mustang. And I'm like, heck yeah, man. Like you did it. It took you till you're retired, but man, you're driving the car you probably wanted your entire working career. If I could have got out at the stoplight and give him a high five or something, I would have. But I mean, it's just like, that's awesome that he made it happen, And sometimes they're the slower drivers on the road, even though they got the fastest car, which I chuckle at, but that's a side point. But you could do all those kind of things. You can enjoy life. That's what we're here to do: experience life, to travel, to be with kids and family. And I spoke about this in other videos. Part of one of my hard lessons this year has been I was pushing really hard to work enough to where I could get my time freed up. And my dad passed away earlier in the year, and I kind of learn like, oh, maybe I should be living life now, not putting it out to this point in the future, thinking everything that I know of it today is going to be the same in the future. Maybe I just need to live more now, and things will take care of themselves down the road. And so the death benefit part of whole life insurance can come in at the end and, basically recoup everything that you've spent. So if you have a $500,000 portfolio and you blow through that, enjoying the heck out of your retirement, you've created all these memories with your kids and grandkids, and you've traveled and all this kind of stuff, and you're just enjoying life to the end. Number one, you're going to, as you mentioned, the stress level, you're going to be probably living longer and living healthier. You're going to have a better mindset. You're probably not going to have depression or a lot of these things if you're living life that way. And that's a total another video. But just knowing that, okay, I've spent all this and I've got a death benefit, maybe for the exact same amount, 500,000, that when I pass, that's going to go on to my heirs. And I know I can bless my kids and grandkids to start their life, not over at zero to where they've got to start saving up money and like they've never worked before. I can bless them maybe with, 100,000 each or whatever the numbers would be. That is a powerful piece of the puzzle that you can't get that from any other financial product.
Right.
It's a multiplied transfer of money at death. Whatever you had in your policy in the cash value, it's more than that typically. The transfer, at least the way we design them, I'll give that caveat. It gets transferred to, if you have, $250,000 in cash value, you're probably gonna get 400,000 or 500,000 that transfers in death benefit. Again, variables and how it's set up, but that's the idea. There's more that goes there. Whereas a normal portfolio, if you have $500,000 in stocks and it goes to the next generation, well, there's a taxable event in there. So they're not going to get all 500,000. It's going to be less than that they actually get to start their life with. So it's just a very efficient way to transfer that. So it's a powerful point to what you were talking about. And it made me think of even another point around all this is, as I've been working with this client, it made me think, wow, this person has worked very hard their entire life, saving up, done a tremendous job of doing that. But I went and bought, I had a term life insurance policy when my wife and I were married back in 2013. And then my whole life that I've had is my seventh year of my whole life policy. And I basically bought on the front end 90% or so of what this person worked their entire life to have, which is at the end of their life, what they could transfer to the next generation. So
Right.
like Garrett Gunderson talks about it in What Would the Rockefellers Do? It's buying your net worth. So
Hmm.
I bought my net worth 7 years ago. I've been 31 when I bought the bigger whole life policy that gave me, I think at the time it was a $441,000 death benefit. But here's the cool part. I can't remember if you talked about this in the Dominican when we were together, or somebody had mentioned it recently. I was thinking it was you about the rate of return of the death benefit. And that's something that nobody talks about. Like my death benefit now is over 600,000, I think maybe 660 or something like that. That's a
Right.
50% growth of my death benefit
Yep.
in 7 years. And it's not like I put in that same amount of cash value in my policy, not even
Not even
close,
close. Yeah.
nowhere near close. So what is the rate of return of that? We talk about the cash value growth, but what about the death benefit growth? I
Sure.
just increased the net worth in my family by 50% in 7 years
Yep.
with the death benefit growth by the way that we structure these policies. There's nothing on the planet that's going to do that for you. That's powerful.
Yeah.
And I did that in my 30s. I didn't have to slave and sacrifice until I was 65 to come up with, I think I'm a little short of maybe just over 900,000 between my term and whole life of death benefit right now. Like that's significant. I didn't have to work my whole life to try to accumulate a portfolio of 900 and
Right.
some thousand. I
Yep.
got it by buying it up front. And what that means for, my family is very game changing, because if I were to pass away today or tomorrow or whenever, that money goes to my family tax free. They
Yep.
start with that amount of money. Now, there might be a few debts to pay off or something like that, depending on business transactions and all that kind of stuff. But at the end of the day, I know my family's well taken care of, not just for the next few months. And my wife's got to go get two jobs and try to take care of the kids. Like, no, no, no. This is like next decade, they're taken care of,
Yep.
very well. And they know what to do with the money if that happened. They know how to structure it to make sure that, that goes on and continues to go to work for the family for, maybe the rest of my kids' young life, who knows? So that's one
Yeah.
of the big powerful points. Anything on the death benefit you want to share before I talk about a couple?
That's freaking awesome, man. It's one of those mindset shifts
Mhm.
around personal finance, different financial products. This the way that we're taught about them. Because what do we normally hear about whole life when it comes to the death benefit? It's so much more expensive than term,
Mhm.
right? But the difference is the term isn't going to do anything for you. That doesn't mean you shouldn't have it. I'm not saying that, but most term policies don't pay out. So it's not going to be there when you need it the most, which is when you're much older, we're finally ready to kick the bucket and graduate this life. Well, that policy is gone. That death benefit is gone. Versus with the whole life policy, which I'll just throw this out as a side note. You don't have to pay into it your entire life, guys. You could pay into it for 7 years, 10 years, 20 years, whatever you want. And then that thing is paid off just like a mortgage on your house, but it's going to continue to grow. The cash value and the death benefit is going to continue to grow without ever making another premium payment ever again. Now, yeah, I think it's so powerful what you mentioned, like buying the net worth and building your cash flow. Like I think that's one. If I had to put something at the top five on my list of most powerful paradigm shifts that I've had going down this rabbit hole, that would absolutely be one of them. Because if you think about it, how long would it take? Just take whatever you're currently contributing to your portfolio right now. All right. How long is it going to take to reach $1 million? Think about that. Okay. Now, again, I'm not saying not to contribute to a portfolio. We're just putting things into perspective here versus if you were to buy a whole life policy, probably with a term policy on it, all right, to get to the $1 million, you could have that instantly. Like as soon as you're approved and the policy is issued, you have now just significantly increased the net worth of your family. How long would it take a portfolio of stocks and bonds to hit that $1 million mark? Jeff, I look at these numbers all the time. Most people never reach the $1 billion mark in their 401k or tax qualified plans ever,
Right.
regardless of how amazing the market is. And a big part of that is contributions, obviously. Okay.
Mhm.
But the point is, if we could buy our net worth, focus on building the cash flow, let the death benefit be the legacy play. Like, do we care if we pass on stocks or real estate, or how about just net worth? We're just passing on net worth. And then they can do with it what they want or according to the trust, however you set it up. But it seems to me that if we're talking about a legacy play, passing on something to the next generation, there's just nothing that even comes remotely close than whole life insurance. And when you take into consideration all the other benefits, all the other things that I can do in our personal finances, again, for me, it was a no-brainer. I just looking at all of these benefits. Yeah, I take a little bit of a hit in the first couple of years, takes a little bit to break even. That was about it for me, though. That was like the only potential, like if you could call it a downside, but it's like it's not like we're just giving our money away. We're buying life insurance. There's a cost to that. So it's not like we just lose money out of thin air, right? But if that was that was like the only minor con for me, everything else just like smoked the cons, like the all the pros of this thing, all the benefits that we get. It's a no-brainer to me, right? There's just too many benefits from it not to at least give it some consideration. So that would be my point on that.
Yeah, totally. Yeah, all good stuff. So let me go back from, talking death benefit, legacy play. Let me go back to the very beginning and some of the evolutions I've had on the front end of considering whole life. I think in my early journey, it was everybody needs whole life. Like I already stated, like get rid of everything else in your portfolio and do everything in whole life. And it didn't matter even where you were starting. Like you could start with a small policy, like get your foot in the door so you get your whole life, which there's some merit to that because you're locking your insurability and some things like that. But what I've discovered, I don't want to say what I've definitely discovered, and you may agree with this, Matt, but is a lot of people aren't ready for that. They're not
Right.
at the financial place to be mature enough to handle a whole life policy. It's
Sure.
not the right thing for them. If they have debt, if they have a spending problem, if they aren't making enough money. You and I have done a lot of content on just increasing income. Sometimes we don't have a debt problem only. Sometimes we have an income problem too. And we got to get that part figured out. Figure out your
Yep.
business or figure out, your own personal value and your own self-worth and get those things up there to where the money's coming in that's in alignment with, who you are as a person. Like that's a whole nother video as well. But one of the things that, I probably turned away more people that have come to me, interested in the idea of infinite banking and stuff. And I say, hey, you're not at the place, you're not ready yet. You need to
Yep.
get your foundation in place first, which means having an emergency fund, which means having savings, which means, sometimes paying down debt first is a good thing, like getting rid of most or all of your debt before you even consider a whole life policy. And I know there's a lot of people out there, and I was kind of trained this way on the front end of my career was, let's not worry about all that stuff. Like, let's just get them into a policy because it's a sale, right? And you see this with IU all the time. Oh, you can do $50 a month, Matt. Like, let's get
Yeah.
you in, man. It'll grow to millions of dollars. And it's like, no, 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 no. We have a
Yeah.
fiduciary responsibility to do the right thing by clients. And if we have a sense that they're not in the place to where they can manage something like this, which is not even really any management to it, other than paying the premiums and making sure you do things that are going to advance you financially and not put you into a further debt cycle, because you can screw up a whole life policy by you
Sure.
can, leverage the heck out of it, taking policy loans. And if you miss some payments or something, like, hey, you can screw it up. And we don't want to put a client in that situation. We're not so eager to get a sale that we want to do that. We want to make sure, and we have part of Life 180, a financial hierarchy. We want to make sure that you have the foundation pieces set first before you even start looking at whole life. And usually that means savings and emergency fund and having insurance protections correct, like on your home and on your car and on your life, which may mean term life insurance. That was, again, an evolution that I had early on. I was completely against term life insurance. Like, oh, it's terrible. It's a place that, only 1% of policies pay out, but it serves a function. It is still a
Sure.
financial tool that serves a function. I've since learned, and this is part of the evolution as well, that it's not just all term life are the same. There's something called convertible term life insurance. You can convert a portion or all of that over to whole life over time. There's things called living benefits term that gives you access to a portion of your death benefit if you have a chronic, critical, or terminal illness, which means if you don't want to go maybe for drugs and chemo and radiation, if you have cancer and you want to go to an alternative clinic, but that alternative clinic's $250,000. Well, if you have a big enough policy, you could get an advance of your death benefit with living benefits, and you could
Yep.
maybe go get stem cell therapy or go wherever the heck you wanted to go and have a higher probability of, surviving something like that.
Yep.
And we talk in other videos about Chris from Life 180. His father-in-law went through that exact scenario. He's alive after a 90-day diagnosis with pancreatic cancer 4 years later. like still playing golf multiple
Incredible.
days a week. Like he's still doing very, very well because of this exact thing. So that's part of the idea here is getting, your death benefit covered, having your life protected, having a lot of these things in place. And then when your finances are at the tipping point where, hey, you've got money put away, you're in a cycle and a habit of putting money away, saving money. Your savings are growing generally every single month because your income exceeds your spending and you're being responsible. And maybe you've gotten rid of some emotional habits around why you aren't or haven't been that way in the past. Then you're probably ready for whole life. And especially if you've got a business and you've got a lot of cash flow running through your hands and you're wanting more financial efficiency. Hey, I got, $250,000 running through my hands through my businesses. Like I want to make it go further. Probably at a good point to where let's start talking about whole life. Let's see if there's a way that tool can make you even more efficient with those dollars, because more than likely it is. So that's one of the big things that, I can think through my mind, multiple people that they've come to us like, oh, we saw your presentation, Jeff. We want to do infinite banking. It's like, great, let's examine where you're at. And we look at it and we're like, guys, you're not ready for that. You're just not there yet. The income's not there. Maybe the debt is too much, or the way you're communicating to me, you're just not ready for it. And we say, time out. Let's revisit this in a year, maybe 2 or 3 years. Like focus on paying down your debt. Call us back in 3 years. We'll see where you're at. Stuff like that is very, 100%. Very important. So,
yeah, I agree, Jeff. So I've gone back and forth on this aspect of whether or not whole life is for everybody, and here's how I think about it now is I do think everybody should have a whole life policy at some point. Maybe not right now, but when you're ready at that point and it makes sense, yes. Because here's the thing, I mean, it's one of those tools, first off, it's called the and asset for a reason. So people think that I can either invest my money or do whole life insurance, and that's not true. We can do both because we have access to the cash value. I do this in my life right now, with my private money lending. I borrow from my policy and then I lend it out, right? So you can do both. You can have whole life and investments. But I do just, the more I go down this rabbit hole, the more conversations I have with people. I was setting up a policy. We were doing an illustration on a client's 3-year-old child. I mean, like the numbers are just unbelievable, and just how powerful this thing is going to be for her entire life. Like it's going to be there for every major event, life event throughout her entire life. And I'm just thinking to myself, why doesn't everybody have this? Now, again, not everybody's right for something or ready for something like the infinite banking concept, or like you alluded to earlier, you're putting $50 a month or $100 a month into this thing. It's just not going to move the needle. You're not capitalizing it enough. You have an income and cash flow problem right now. You don't have, well, I guess we could argue that maybe there's a financial efficiency problem as well, but the next phase is like the first step is increase income and cash flow. Then we're going to be far more efficient with our money by placing it into a vehicle like whole life. And now we're going to deploy that capital, right? We follow that process, but a lot of times people are skipping ahead and they're getting excited about the strategy, the product, whatever, but you're not in a strong enough financial position in order to get all of the benefits. The good news is, as you alluded to and mentioned already, Jeff, is that there's other things you can do right now, like the convertible term policy to lock in that insurability. You can convert that into a whole life policy later on down the road after you've cleaned up your income, cleaned up the debt a little bit. And so, yeah, it's I think it absolutely is for everybody, just not for everybody right now. Where, because everybody's situation is a little bit different. Sometimes people do need to fix their income first, then do something like infinite banking. Some people need to clean up the debt. Some people need to shift their mindset around money as well. Because I was talking about this in a video I was doing earlier. I was actually talking about the risks of taking policy loans from your whole life policies. And at the end, I basically summarized it saying that you are the greatest risk to the policy, because the policy is going to do what it's meant to do, whether you use it or not. It's going to get that guaranteed growth, most likely going to get dividends, you're going to have the death benefit, whatever. But if you start screwing around with policy loans and then dumping it into like, the latest cryptocurrency project or something like that, and you're taking vacations with it, not paying back the policy loans, well, you haven't had a big enough paradigm shift financially around money, that is, to be responsible to be basically to be ready for something like this, because it takes a certain level of financial responsibility and maturity to do these things successfully. Otherwise, you could end up in a far worse position than you were before you started it, right? So yeah, I think that's really important. I do think I can make the argument that whole life is definitely for everybody because of how many benefits it provides. It's just not right for everybody right now.
Mm-hmm. Yeah, I think it's well said. Yeah, I think I've come to a very similar conclusion as well. I think it's one of those things, a phrase I'd heard back in a lot of my personal development, where, if somebody is going for goals and dreams, and you're is like maybe a mentor to them or a friend, like, I believe you can do that. Like, there's a capacity to do that, but I don't necessarily know that you will do that. And I think the
Right.
same thing holds true with policy. I think it's good for everybody if they get to the place to where they're aligned with being able to
Yep.
manage it and stuff like that. So
Yeah.
I'll
100%.
I'll finish up with the last couple of thoughts around my understanding of this product and this tool as it's evolved over my years in the industry. One of them is seeing gaps in a financial plan that don't often get talked about. And the more I work with clients, I'll keep referencing the one that I've been talking about this whole time, that had the 70% in the market, and 30% outside that. Didn't have whole life insurance at all in her portfolio. But one of the couple gaps that I've seen, that other products outside of whole life, because whole life can't fill these gaps, but there are other tools that fill these gaps. So one of them is, okay, when we're in the distribution phase, we're in the income phase of retirement, how do we have a portion of that income be fixed and guaranteed? Back in the olden days, and I think both of us are kind of the age where pensions are a thing of the past. Nobody really has pensions
Right.
much anymore, but like our parents grew up in the generation when pensions, which were guaranteed income, were all the rage. That's what everybody relied on. That was like a gold standard. I'm going to go to work for a company that has a pension because I know I've got income for the rest of my life. It's a powerful thing. Well, then it got switched, back in the 70s or 80s, I think it was, to 401ks. And we went down the
Right.
investment track, and it pulled away from that because it's cheaper for the employer, right? I mean, it's just kind of it comes down to profit and money, right? It makes a lot of decisions. So a lot
And it's
of
a
what
huge
people,
money maker for Wall Street too, because they're managing all the products that you're putting your money into.
exactly. So, a lot of people that are heavily bent on rate of return, having money in the markets, they're relying, and you said it perfectly earlier, the tools that help grow your money the best are not the same best tools that give you the best income. There's
Right.
other ways to produce income in a more efficient way, which means I
Correct.
put $1 in and I'm going to get, $1 into this instrument, and I'm going to get the most pennies back out, versus in like an investment where I put $1 in and I might get out, 80% of what this other vehicle would do. The other vehicle could be annuities. And there's,
Right.
differing opinions on annuities, but thinking of, what we've been trained with, life insurance. Life insurance is guaranteeing, the value of your life gets paid out. With annuities, it's guaranteeing your income. So yes, you're sacrificing a portion of capital or your portfolio to be the balance that goes into an annuity, but then the insurance company is on the hook to guarantee you get a monthly check as
Right.
long as you live. I mean, there's different annuities, all kinds of different annuities and everything, but generally speaking, when we're talking about it in this context, it's something that we're going to guarantee that you're going to get X number of dollars out of that. So whatever money we put into an annuity is going to guarantee us more income, a higher amount of income than, say a traditional retirement or investment account is going to be able to produce safely, because there's no guarantees on that vehicle, and there's just safe withdrawal rates, which can be, anywhere from 2 to 4%, depending on what guru you're listening to. And a lot of that's backed on actual, actuarial science and running
Right.
Monte Carlo simulations. There's been a lot of studies done on how much of my portfolio can I spend down every single year without jeopardizing running out of money. And they've
Right.
come to 2% on the low end. Some will still say upwards of 4%. I think 3% in theirs,
I've heard 8% from certain
well,
gurus,
yeah, I've heard up
because
to
you make 12% in the
12%.
market every year on
Yep.
average.
Yep. I know. Yep. And
It's
that
crazy
can be
stuff.
a problem, because if you go into it thinking I can get 6, 8, 10%, because the market's supposed to grow that way every year based on average rate of return, not actual, there's
Yep.
going to be years you don't hit that 10% or that 12% in your market growth. So you can't pull that much out. And it's just that
Right.
adds more risk into your, retirement income years. And so we don't want to do that. It's fine to have some allocated in risk, but we
Sure.
also want to have a fixed amount. We want to have all of our living expenses covered with fixed income through like annuities and such, so that we know our bases are covered. And then anything above and beyond that, we can pull from the stock market, invested portfolios if we want to do more, or, just we've got that flexibility, but we're not reliant upon that, because that
Right.
is not going to, cover all your risk. Because a lot of what we're looking at is the risk involved with what we're doing with our money and trying to
Right.
minimize risk and increase efficiency. And if we can do both of those things, then we've won the financial game, especially as we get into retirement.
100%.
And one of the other, do you have a thought?
Just real quick on the annuity aspect of it. Again, it's a shift in mindset and just how we think about these things, because typically from mainstream financial media, you hear about annuities. Oh my gosh, they're a scam. You want to stay away from them, whatever.
Yep.
But here's the real question is like when you hit retirement, what do you actually care about now? Is it growth or income?
Mm-hmm.
It's going to be income. So if you could get the same amount of income, let's say you've got $1 million portfolio, you're going to stick to the 4% rule, you're withdrawing $40,000 per year. Okay, now we're going to keep it simple. We're not talking about taxes and all this stuff. Okay, $40,000 per year. But what if you could what if you could get the same $40,000 per year for like half the money? Maybe a little bit more, depending on the annuity. If what we're trying to solve for in retirement is income, why on earth would we not consider one of the greatest tools for creating guaranteed income on the planet? Like, why are we so obsessed with maintaining a stock portfolio? Look at this big pile of money that I have. But if you're not spending it efficiently, what's the point? And if you're in a constant state of stress because you're worried about what the stock market's going to do, and you've got to battle inflation and all this stuff, like if we're trying to create as much income as possible from the portfolio, well, why not allocate a portion of that to the greatest income vehicle on the planet, an annuity? Like, are you not going to do it just because annuity sounds awful and I've heard awful things about it? Fine, don't call it an annuity. Call it something else that will help you sleep at night and make a more informed decision. Like, the name of these things doesn't matter. It's what does it do for me? And if I can create the same amount, if not more income with less money in retirement, why on earth would I not explore that? So I wanted to mention that really quick, because that was a big light bulb moment for me when I, again, started running the numbers for myself. It's like, holy smokes, we can create the same amount of income with far less money using annuities. Why are we so obsessed with our stock portfolio here? Why not allocate a portion of it into income? So
Yeah, totally.
powerful
That makes
stuff.
me think to run the actual number. So the annuity that we're doing for this client, roughly 200,000 went into the annuity, and it's producing roughly 18,000 per year of guaranteed income. That's 9%. So if you were to get
Nice.
18,000 out of her stock portfolio, figuring the highest safe withdrawal rate of 4%, she would need to allocate not 200,000 but 450,000.
Right.
That's
For
a
the same
big,
amount of income.
yeah. So which one's more efficient?
Right.
It's obviously the annuity.
Yep.
Yes, you're giving up control of that money, but you're getting a guarantee in exchange for giving up control of that, sum of money. For
But
me,
also real quick on that, Jeff, the reason that you stocked up so much money, you piled up so much money, was to create as much income for
right.
yourself later on that as you possibly can.
Mm-hmm.
So you just gave a perfect example of how to do that.
Exactly. Yep. So let me wrap up my couple thoughts here. So that the annuity part, the income, guaranteeing the income in retirement, is a gap that we see often. And also, as we're talking retirement and kind of the later stage of retirement, is long-term care, and having that
Oh, that's
be a
huge.
missing piece. And I know you've just been recently down this rabbit hole, and I've been learning some
Yep.
little bits over the last several years with One America that has got by far the best product on the market for long-term care.
Absolutely.
And it's a major thing that a lot of people fall into this fallacy, and I see this across the board, all through stages of life, that rate of return is going to fix our problem. Rate of return is going to put our kids through college. Rate of return is going to solve our income problems, and it's going to give us all the income and the retirement of our dreams. It's going to serve as long-term care. And it's even going to serve as a death benefit, so we could be self-insured, because rate of return in our big portfolio is going to save the day on everything. Well, as we just alluded to on the annuity side, there's much more efficient ways to cover the risks and the gaps that we have, especially for long-term care. So there's statistics that with the aging population, more and more people are going to need some form of long-term care as they enter their 60s, 70s, 80s, 90s,
Right.
whatever.
I think
And
it's
so what is,
70% of the population
yeah, exactly.
that will need it at some point.
Exactly. It's a huge thing. So a lot of people are going to be under prepared for that.
Hmm.
I've been through it twice with my grandparents in the last 8 years, seeing that they didn't have coverage. They didn't have that plan for. So then they get to go on Medicaid, which means
Mm.
spending down all assets. There was a
Yep.
car and a rundown house left. It
Yep.
got put to us. Everything else had to be, sold off and done away with in order to qualify for
Sad.
Medicaid. And then you're at the mercy of the care facilities. Luckily, we found a decent one that
Yeah.
took good care of them and had good care and all that kind of stuff. And they both survived, many, many years in that. So it wasn't all bad, but I don't come from the position of relying on the government to take care of me. I want to be
Yeah.
self-sufficient and empowered to where I have more ability to choose my level of care and
Right.
not be succumb to those things. So when we look at that need of long-term care, it goes back again to how many dollars do I have to put towards my care? And is that efficient to do it that way? If I self-pay or have my investments do that, is that more efficient, a dollar for dollar, or in some cases, you're spending more than a dollar because it's in a qualified pre-taxed account, like an
Hmm.
IRA or something. You have to liquidate that in order to
Right.
spend it on your long-term care. So you're getting, let's say your tax bracket's 30%, you have to spend $1.30 to get a dollar worth of benefit. Is that efficient? Help,
Yeah.
like not even
No,
close.
not even close.
So what if we had things set up to where you could put forth pennies on the dollar and get a dollar worth of coverage? That's
Right.
what long-term care accomplishes for us so that we
Not,
have that need taken care of.
yeah, not to mention that if you really believe that your portfolio is going to provide income, protection from long-term care, and a legacy play all at the same time, you've got another thing coming, man.
Yep.
I don't know how the math doesn't add up. Like that's why we probably do another whole other video on this. The concept of being self-insured, in my opinion, is just a complete joke. Because oftentimes you're relying on your stock portfolio, this pile of money that you've accumulated to take care of all of these problems, to solve all these problems, income, long-term care, and a legacy play. You're going to pass that on. Uh, Maybe like you talk about this a lot, Jeff. Like in the best case scenario, could it happen? Sure. But how often does the best case scenario work out, Jeff? It's not very often. Life
Mhm.
happens. Things just don't go our way sometimes. So are you prepared for that? Like when you see the statistics, 70% of the population is going to likely need some type of long-term care assistance. Are you ready for that? Can your stock portfolio handle that? If it can, great. More power to you. I'm gonna roll the dice here though and say probably not. People and Jeff, I mean, you've probably seen this as well. Like people severely underestimate how expensive long-term care is.
Mhm.
Oh my gosh. I just looked at these numbers the other day, Jeff, because I've really been diving into One America's product, which is just freaking amazing for long-term care. Here in Florida, the average annual cost for a decent long-term care facility, $78,000 per year.
Mhm.
That's nuts. And
Mhm.
then the other side of the argument, well, I'll just get long-term care insurance. Good luck, because that thing gets more and more expensive every single year. Not to mention the red tape involved. I've seen this personally with somebody that had a long-term care policy, needed long-term care assistance. There's a lot of red tape that you have to go through to get certain benefits because they don't even pay for everything. Not saying that you shouldn't have long-term care insurance, but man, you better start thinking of a more efficient way to start preparing for these things because if you're relying on your stock portfolio to do all that, you're really rolling the dice, in my opinion. Not financial advice, just my opinion.
Yep. But I think, one of the things with long-term care is when do you do it? Because you want your portfolio to grow through your working years. So I think what I've heard is in your 50s, early 50s, mid 50s, maybe even late 50s is like the window that you really want to start considering long-term care and adding that into your portfolio because the costs are a lot lower because you're a lot younger, but similar to in that respect as like life insurance. And then, hopefully by then your portfolio is grown enough to where you can actually allocate a decent amount, per month or per year into a long-term care policy and then be setting yourself up for if you need it. And then one of the big things with most long-term care on the market is it's a use it or lose it.
Right.
Whatever you put in there, if you don't use it, it's
Gone.
gone,
Yep.
which a lot of people that steers them away because they don't want
Sure.
to do that. Well, that's one of the things where One America, they have the death benefit portion to it
Yep.
that you're at least, it's not 100% of it, obviously, but there's a portion of it that still can go on as another death benefit play that
Yep.
you're doing two things with the same dollars. You're giving
Mhm.
part of a death benefit and you're covering yourself for long-term care. That's more efficient to do it that way, especially than being self-paid or allowing your stock portfolio to do it. Excuse me. So, it's just another efficiency thing. So let me
Right.
finish up on the efficiency piece. One of the other things that's been part of my evolution, this was not necessarily in my long-term plans whatsoever, but as I mentioned earlier in the video, with my dad passing away earlier this year, he did health insurance, senior health insurance. And with getting into the health insurance realm now, I'm understanding more ways to be more efficient with our money, meaning the money that we're spending on insurance premiums. There's a lot of different types of coverages out there, ways to shop around, using different tools in health insurance to be able to cut down on your monthly costs, increase your coverages, and that
Yep.
puts more money in your pocket. Maybe to pay down debt faster, or maybe it's to fund a whole life policy if you're at that right place. But there's a lot of those types of things that I didn't know early on. Of it was just all focused on whole life, but then you start really understanding what does it mean to be a financial or a wealth strategist. It's understanding somebody's big picture finances and where can we become more efficient with different bills and where your money's flowing. And it's not all about whole life insurance. It's about things like this is, can I save you 200-300 bucks a month on your health insurance and increase your coverage? If I can
Sure.
do that, that's a game changer for a client,
Yeah.
And so
You
those are
just did that for me,
exactly,
and it's
exactly.
awesome.
Yeah, exactly. So,
I'll take an extra 200-300 bucks a month. That adds up, man.
yeah, it does. It's totally, and then if you can do, there's a lot of other strategies that people like Garrett Gunderson talk about on the efficiency piece. And I know we've created a lot of other content on that. I'm not going to go into them all now, but that's one of the newer pieces that I've evolved in understanding is like, okay, even health insurance plays into this overall financial game. And are we winning? Are we losing? Are we doing the smartest thing with our money? Are we not? Are we, what Garrett calls leaking cash flow? There's a lot of places that we are. There's always ways that we can improve that and shop around
Yep.
and just plug those leaks so that we're not doing it. So
Yep.
the very last thing that I'll mention here in my evolution, I actually learned this at a One America symposium like 2 summers ago, was talking about whole life and how it can actually be used as a tax strategy later in life. And I saw this play out literally a month or two after I learned about this with my own parents. My dad, 2 years ago, I think it was, had a really good year. He sold a lot of insurance that year and had made, I think, the most money he'd ever made. Well, had just started Social Security. My mom had just started Social Security, getting paid from that as she was already retired. And what I learned at Symposium was if you have money in your overall portfolio inside of a cash value life insurance policy, when you're looking at, if you're using that to use for some income in your retirement,
Mm-hmm.
that would be off the radar screen of taxation. So what my parents
Right.
had happen was because my dad made so much money, and it was obviously through his job, it wasn't through income sources of, retirement and that kind of thing. But he made so much money that they were taxed about 50% of what my mom made in her Social
Yep.
Security. So they had to repay like $9,000 when she got like, I think a little less than 20,000, all because it was basically a success tax. You
Right.
were on Social Security, you made too much money, and so
Mm-hmm.
we have to repay that. So I know that's not quite apples to apples, but if they were pulling money from, you know, um, income with IRAs or 401ks or those types of things, but they had some in a whole life, that might be enough coming from the whole life that was off the radar screen of the IRS,
Right.
all legally, nothing screwy, that would keep them below a threshold where they wouldn't have to pay other taxes. And it may not just be Social Security. There's, I think, 3 or 4 other types of taxes. One, I think, is called the NIT tax. And there's a few other ones that if you make like over $140,000, $150,000 a year, obviously for a lot of people that won't kick in, but for those that do, whole life can be a shelter. If you have a percentage of your portfolio in cash value, it keeps you below that threshold and keeps a 2.5% tax off your, tax income tax return for the year. Saves you money. And so those are some of the missing, that it's not the sexy, TikTok videos talking about, hey, I'm going to save you 2% in your retirement off of this one tax. But those are the big things that are the overall efficiency that are part of a good, solid financial plan when we're seeing all the moving pieces and all the potential gaps, all the potential risks that can come into play. Whole life can check so many of those boxes in a way that no other financial instrument can't. 401ks can't, 529s can't. IRAs can't. Roth accounts, can be good because of the after-tax nature of them, but even those can't check the number of boxes. Most of those are one or two boxes that they're going to check, and that's it. Whole
Yep.
life, depending on how you're using it and when you start it, and how long into your life you use it. I mean, it can be checking 6, 8, 10 boxes of what it's doing with a dollar that goes in. It's accomplishing multiple things with that, and that just goes back to the overall efficiency of it. So those are a
Yep.
lot of the things that I've grown in my understanding in the years in the industry. Any closing thoughts for you, Matt, as we wrap up?
Yeah, I'll just finish up on that point about efficiency. As I've learned about this product and I've implemented it and used it in my own life, I haven't seen or found a more efficient financial vehicle yet. If it exists and you guys know about it, drop it down in the comments. I'd love to learn. But I haven't seen it. This thing solves so many problems with the same dollars. And it allows us to be so much more financially efficient. It puts so much more wealth back into our lives, our own personal finances. It helps plug a lot of those leaky holes in the bucket, as you mentioned earlier. And at the end of the day, I think it's at least worth considering, regardless of what you've heard about it. All right, put that aside and take responsibility and do your own research. Because I'm confident that when you do that, you're going to come to the same conclusion that Jeff and I have, is that these policies are just absolutely phenomenal when it comes to establishing a really strong financial foundation and solving so many different problems with the same dollar. So yeah, that's what I would wrap up with. Good stuff.
Cool. Yeah, good thoughts. Well, thanks for joining me tonight, Matt. I appreciate it.
Yes,
Love
sir.
spending
Thanks
time
for
with you,
hosting.
creating some content. And
Yeah, man.
definitely check out Matt's channel, Millennial Wealth Creator. Make sure you're subscribed to that. He creates awesome content, especially around some of the money journeys he's on and outside of whole life. He's got some great content on his journey. You can learn a lot from what he's doing and maybe get into that yourself and have an alternative way to make some money. And make sure you're subscribed to my channel here and alerted to when we create new content like this one. And yeah, thanks for watching, guys. And we'll catch you in the next video. Take care.
Awesome. Take care.